Hello, friends. Welcome back again to another episode of Unplugged with Jas Oberoi. Today, I'm going to be talking about a topic which is the talk of the town, and everybody is curious about it, what is going to happen, which is capital gains. So, I thought, why don't I bring a person who's expert in it and an accountant who can tell more depth in it? And here we are with Mandeep Tung from Affinity Accountants. And thank you, Mandeep. Thanks for coming in.
You're welcome. Thanks for having me.
Yes.
Yeah.
I know you're a busy person, so I appreciate you coming all the way and taking out your time.
Yeah.
Before we dive into the accounting side, why don't you tell the viewers, I know who you are, but why don't you tell the viewers a little bit about yourself?
Okay, for sure. So I'm a CPA. I've been in accounting for about 20 years.
Amazing.
Really,
okay, that
really
I didn't know
ages,
it. 20 years?
20
Okay.
years. 2004. I started in 2004 with a small accounting firm
Right.
in Surrey. And then from there, I moved to KPMG, where
Okay.
I worked there, got my designation there in 2008.
Nice.
And I've been practicing since.
Since then.
Yeah.
No, amazing. So
Yeah.
now the firm, it's your own firm, right? Affinity.
Yeah, so we started our own firm in 2016. So
Okay.
it was 2 partners initially, and now there's 4 partners, and we've grown quite a bit.
Amazing.
So 4 partners, we're a full service firm. We do everything from tax planning to audits, and everything in between,
Yeah.
and even bookkeeping for some of our
Yes.
clients,
Yeah.
right? There's a heavy focus on structures, corporate structures, making sure that they're optimized,
Yeah.
right? So the biggest issue we see is people just incorporating companies
Yes.
all over the place, and there's no tax efficiency
Yes, I
created
know.
with that, right?
And the
So, yeah.
reason I was just giving a big smile on it because when you said people having incorporations, I'm one of them who was actually not very well organized and
Yeah.
was just opening companies and
Yeah.
not able to manage it. So no,
Yeah.
I agree with
Yeah.
that side too. So now coming about capital gains, everybody is talking about it. Is there really skies falling? Is it really something happening big here?
It is a big change.
Okay.
It is a big change. It's impacting a lot of people, right?
Okay.
I mean, define big, right? So
Yes.
it is something that, if you do have a bunch of assets in a corporation or even personally, you will be impacted by it.
Okay.
So high level, what's changing is, so the capital gains used to be only 50% taxable,
Right.
right? So only half of your capital gain would be taxed.
Yeah.
Now it's going to be 66.7% taxed.
Okay,
right?
so when you say 50%, a lot of people have that impression because of the people I've also being into real estate, people
Yeah.
calling me and saying it. They are always under the impression that if they're making $100,000 profit, 66.6 will be the tax.
No.
Exactly.
No, that's
It's
not the
not.
case.
Yes.
Right. So it used to be if you're making.
Let's take a number, 100,000,
Yeah.
so make it more simplified for the viewers and
Yeah.
listeners. Okay,
Can we-
100,000 is the profit.
Nowadays, the profit, I would say, some of the people that are holding properties,
Yeah.
let's talk million.
Okay, let's
Right?
take it.
Let's
okay.
talk
a million.
million,
Okay,
right?
my profit is, I purchased a property 10 years ago.
Yeah.
Now my profit is $1 million.
Okay, so let's talk million. So million, it used to be only half of that would be taxed.
So which
the
was
gain.
500,000.
500,000 would be taxed.
Yes.
And then you would pay approximately 25% overall. So
Okay.
it would be 250,000 used to be the tax bill.
That was in the case if you are having that under a holding company.
Technically,
If
yes.
it is under my
So-
personal name,
So same idea, right? It would be 50% taxed.
Right.
And then you would pay at the highest tax bracket. You would still end up sort of in the same place. Right?
okay.
So about 250,000 of tax, right? Now,
Yeah.
so that's changing where now the taxes are you're not taxed on half of it, you're taxed on 667
something. Yeah. Let's
right?
easy
Yeah.
math would be 665 basically.
Yeah, exactly.
665,000 you
Exactly.
have to pay a tax
So-
on it.
Exactly. And then you're paying tax at about 50% of that. So you're ending up at about 330 thousand
No,
of
so
it.
Mandeep, okay, I have a profit of $1 million now. My capital gains tax income bracket will be 66, not bracket, sorry, the amount 606. Let's make it simplify it
600
650. Let's take
Okay.
it 650.
Okay.
65%, let's say it. So
Yeah.
650 is taxable.
Yeah.
And what would be my tax bracket? Is it
So-
based on my personal income?
So if it's personally, yes,
Yes.
it's based on your personal income. But personally, there's some exemptions there. So
Okay.
I'll talk about that.
Sure.
But in a corporation, what will happen is that 650 or,
What is 500?
right?
Used to be 500.
Exactly. So you're going to end up with tax of about 330,000
More.
on the million, right?
Okay.
versus the 250. So there's
Yes.
a 80 grand difference
in it.
in taxes.
And that's
right?
a lot of money.
That is a lot of money
money.
for for just paying tax on that 1 million of accrued gain there.
Yes.
Right.
Which was not there before. And this has only been proposed. It's not been
It's not legislated
yet.
No, so it's just proposed, and we don't know the details in it yet.
Yes.
Right.
But a lot of people are opposing already it. And the finance minister said it only some percentage, I don't remember the exact number.
Oh, yeah.
Like 5% of the people are going to be affected
no,
or something.
it's like less than 1% is what they're saying.
They're saying it, yes. So is it true? Less than 1%?
No, I think there's a lot more people
Actually,
impacted.
I think she made a mistake. She's supposed to say 99% people will be getting affected.
Yeah.
She said 1%, maybe saving
so
it.
honestly, the reality is, okay, so there's individuals are impacted, right? So say you have a cottage or like a vacation property or something.
Right.
Or you have a rental property. There's a lot of individuals that are employees somewhere and they have a rental property.
Yes.
Right? And if they have a rental property, now if they ever sell it and this inclusion rate applies, then they're paying additional tax on it. The only thing, the benefit you have as an individual is every individual gets the first 250,000 of the gain will be at the old inclusion rate. Right?
Okay, let's go back then to the same form example. I made $1 million profit. It is under my personal name. So what will be the benefit I have it versus the incorporated if it was not?
So if you're personally owning this property and
$1 million is the gain.
So 250,000 of that gain will be taxed at
previous bracket, which was
exactly
whatever,
at 50% and 25% tax rate. So let's just forget the inclusion rates. Let's just talk tax rate.
Yes.
Right. So that'll be taxed at 25% approximately.
Okay.
Right. And then after that, the remaining
will be taxed on
750,000 will be taxed at the 33%.
Okay. Yeah. No, actually not 750. Won't be. It's a 50%, 65% of it. So 650.
No. So it's the first 250 of the gain.
Yeah.
Is at 25%.
Okay.
Right. And then the remaining 750 is at the 33%.
Sorry, Mandeep, I'm getting confused. So $1 million I made a profit.
Yeah.
Isn't it 65% of that is going to be taxable?
Yeah. So that's
$650?
the inclusion rate.
Inclusion rate.
So forget the inclusion rate. So I'm kind of almost stepping back and just like, how we're saying 500,000 used to be taxed.
Yes.
And it would work out to be about 25%.
Right. Yes.
Right. So now what's happening is the first 250, the 50% of it is taxable at the 50% rate, right?
Okay.
So ends up being 25% on the first 250,000.
And then the
remaining 750 is taxed at the 66%. But then when you factor in your tax bracket, you end up at about 33.
And they are taking this for the voting, I think, in June sometime?
So
it's only
no,
proposed.
this is actually, so it'll come into legislation later. But like what's happening is June 25th is the date that they're saying, okay, we're changing the inclusion rate as of June 25th.
As of June 25th, okay.
Yeah.
And is there a chances this can taken back by the government, or is it going to go? Or is
I
the
was
opposition
reading,
party
honestly,
voting?
I was reading earlier, and there are some articles out there that there's a possibility, but no one's holding their breath.
I read one article where the doctors have opposed about it, and Trudeau brushed it off, and he said no.
Oh yeah,
He said
so
no.
Doctors are, because here's the thing: everyone, the way they're sort of marketing this budget, right, is that they're taxing the wealthy.
Yes.
And reality is, okay, so there's a lot of people out there that have small businesses and they're set up in a corporation setup, but they're not wealthy.
Yes.
Right? So those people are impacted. Right? So they're not taxing just the wealthy. Individuals, so one of the other things that we need to think about is you've got a husband and wife, older, they own assets. Usually when a husband passes away, everything transfers to wife, tax-free sort of, right? Say that happens. When wife passes away, so anyone that's a surviving spouse holding all the properties, right? When she passes away, there's a deemed disposition of all her assets, right?
Okay.
Which means consider all the assets are sold and taxed.
Oh.
This is not a corporation. This is just a
Random old lady who's
right?
who's a single lady.
Yeah.
She passed it away, so everything, whatever the assets, the house is the biggest asset. Majority of the people has
So
it. Let's say
principal residents will be protected, but apart from that, so say she has like an
another investment property.
or portfolio,
Yes.
right? Everything that she owns will be deemed disposed, and then the high tax rates apply there. She'll get the 250K exemption like any individual, right? Where you're taxed at a little bit lower for the first 250 of the gain,
Right.
Right. After that, all her assets are taxed at the higher rate, and this is something that we're thinking just the corporations are impacted.
Yeah.
Right. So
No,
this is
everybody's
beyond
getting
that.
impacted.
Yeah.
Now, coming back to it as saying that I have the mindset of, okay, one is the rule has come up. This is what it is. Either you can crib about it, cry about it, or you just live with it. Now, this rule is, let's suppose it comes in as a legislation.
Yeah.
How a person can be more smart in terms of investments, how they can save more taxes now because it's coming.
Yeah.
So you can't do anything about that.
Yeah.
So what can they do extra? Is there anything, or is it too early to think about it? Like something can be done to save?
Well, right now, the calls that we're getting right
Yes.
now, as soon as the budget was announced, right away, people are reaching out. They're like, "What do we do? How do we
Yes.
not pay this high tax later?" Right? It's really tough to plan any of that because you do have up until June 25th, where the taxes are low.
Yeah.
Right? But people can't make those moves right now.
No, it's too
right? It's
too
too
quick.
right?
Too quick.
If they had said,
Next
June,
year, 2025.
so June 25th of 2025, we
Yes.
could have planned something, right?
Something in there.
And if they had provided a draft, the other thing is there is no draft legislation that they provided. So we don't know the finer details.
Why they haven't done this? Is it like a regular practice? They don't
Normally,
usually do
they would be like, okay, these are
They would do it.
like
They
details
will get-
around this, right? But there's nothing out there, right? So it's like we just know high level,
Yes.
this is what's happening, and we have till June 25th to trigger taxes or trigger some capital gains. But they didn't give us enough time. So if you have a real estate, you're not going to panic sell that real
No.
estate.
Yeah,
Right?
no.
That's something that you've held on to with accrued gains on it. You're not going to react that quickly and pay heavy tax
Right.
even before it's legislated.
So
right?
nutshell is basically it is what it is. It's coming.
It's coming.
Yeah, it's
and
too early to comment on.
Exactly.
Think about it. How you can.
Up until June 25th, I wouldn't really do anything. Like personally,
Yes.
I don't think.
Yeah, you don't want to spend your time and then feel like, okay, it didn't even pass.
It didn't pass, or there's there's
Some changes in
it. There's finer details. Now in the budget, they expect people to react to this, and they expect about 7 billion of tax revenue to come in because of this, because they think that all of a sudden people are going to start panic selling
Yeah.
and triggering gains, right? So they're expecting that. But I don't think
that's gonna happen.
it's the wisest thing to do unless you're planning on selling anyways. So if you're planning on selling,
Yes.
this year anyways, and if you can make it happen before June 25th,
And that before June 25th, it has to be completed or it can
Yeah,
be
it
under
has to be
contract.
No, it has to be
The completion
completed.
has to be
Completion
done.
has to happen.
Okay. And which is next to impossible, especially
Yeah.
depending on the
Lining
asset,
up financing on the other side, right?
everything,
So it's
the buyers,
yeah.
either
Yeah.
you dump the property at the cheap price to sell it quickly,
Yeah.
which won't make sense because
No.
it's not gonna. You're gonna be losing money. So his point is,
Exactly.
it's too early to do it. Okay.
Yeah.
Now, I have done a lot of time. I vouch very much about holding companies, buying
Yeah.
real estate under holding companies. So you are an expert in it. What is your take on it? Is it, as an investor, is it a good investment strategy if I buy under a holding company, or should I do it under my personal name?
Okay, so there's some things that will not change. One, okay, so you have a corporation,
Yes.
right? In order for you to do a personal investment,
Yeah.
you're going to have to pull that money out first,
Right.
So say you want to make a 200,000 down payment towards a rental property personally, right?
Yeah.
First, you're going to tax that 200,000 personally to yourself.
Yes.
And then you're going to invest it, right? Which doesn't make sense. So for all incorporated people and businesses, it'll still make sense to do it at the corporate level.
So a person like me who has an incorporated company as a real estate company,
Yeah.
so it's more benefited to me or make more sense financially if I buy under a holding company versus a person who's a salaried employee.
Yes.
They're working, and then for them,
It's a little bit different for salaried employees because they get that 250,000
Already taxed on it. They pay the tax on it.
Well, they've already paid taxes on their
Yes.
employment income, right?
Yes.
So they've already paid taxes. It's after tax money, and then when they purchase something and later sell it, the first 250, according to this proposed
Yes.
budget, is still under the 50%
Correct.
inclusion rate,
Yeah.
right? So if you can get, so say it's a husband and wife,
Yeah.
I would put both their names on title,
Okay.
right? If they're salaried employees, I would put both their names on title. They both get 250K exemption each.
Oh, each will get it.
Yeah. So it's
Okay.
not by property, it's by individual.
Individual.
Yeah.
Okay.
So each individual, so if they want, their brother, sister, everyone that's listed on this one property, they can shelter that much at the lower inclusion rate.
Interesting, because the flip side to it is, I know this tax is going to be safe, but on the mortgage side, it's a disadvantage because if you can qualify yourself, why you wanted to include your spouse on it, because the bank is going to give same debt on that spouse where you can use the spouse for some other property.
Yeah.
So that's a flip side to it. But yes, if you're looking at the longer plan, and you don't have to plan to buy multiple properties in sooner,
Exactly.
then
Yeah.
you do it with this strategy, and which is a good thing about it. I didn't know about it. If my wife and me are both on the title, so it's 250 to her, 250 to me.
Yeah. And
Understood.
sometimes, the spouse may not have the same level of income anyways and may not qualify for mortgage
Yeah,
at the same
Yes.
level. So in that case, it makes sense.
it makes sense.
Just
Yes.
add her to the,
Yeah, just my example again will be like my wife. She's a homemaker. She doesn't making that much. She does some admin work here in my company. That's
Yeah.
it. So her income is not gonna on her own
Yeah.
gonna qualify.
Exactly.
Yes,
Yeah.
then it makes sense for me, because if I'm buying a property and again making $1 million profit on it,
Yeah.
then 250 will be exempt on hers and 250 not exempt, but it will be on the old
Or at the
old one.
Yeah.
So now if you are incorporated, then you think it's a good strategy to buy under a holding company.
It is because otherwise, again, that the down payment you pull out or
Yeah.
any funds you pull out to invest are going to be taxed at a
So can I loan to my holding company? My incorporated current operating company can loan it to the holding
yeah. So
company?
you can easily transfer funds from like your operating business,
company too.
whether it's in the form of a loan or whether you're paying dividends up to a parent company which is holding all your
Yeah.
assets. So you can do it, transfer funds, and then use those funds to invest.
For how long can you do it alone? Is there a term like you have to
So
return back
you
the
could
money?
have like set repayment terms,
Right.
or you could have
interest only?
anything like you can set
okay.
up the terms.
Yeah, so I'm
as-
taking an example again is I'm taking $500,000 from my operating company and giving it to the holding company to buy a real estate. So
Exactly.
my holding company just can give the interest on it because I don't have that $500,000 back until I
Exactly.
sell that property.
Exactly,
So
yeah.
for the time period, I can pay the interest rate for as many years, or there's a period where CRA said, though, you have to return this money back now to the operating company.
Well, as long as the company there's because for your company, it's
Yeah.
an investment as
Yes.
well, right?
Yeah.
So if your company is investing and if there's some sort of return that's happening,
rent
right?
is coming or something
Exactly.
is coming. Yeah.
So then there's an expectation of profit, and then
Yes.
you can continue doing that.
Doing
right?
that. Okay, I
Yeah.
understand. If it is a business because you're getting a rent on it,
The only
then
issue is the banks don't like the money going out of operating companies,
Yes.
right? So they'll look
Yeah.
at it and there's like all these funds loaned out
Yeah.
to, so that becomes a little
That-
bit of a
the-
challenge. Yeah.
so is there a better way to do that, or is that's only
Well,
way you can take the loan
sort
out
of
of it?
is
Yes.
the only way if you're going to be, I mean, if you have a parent company set up, you're paying dividends out. So then the bank looks at the full, the
Understood.
parent and the sub,
Yeah.
right? And the subsidiary or the operating company is paying dividends up to the parent company, and the parent company is holding all the assets and investing.
Okay.
Yeah.
Interesting.
Yeah.
Mandeep, also I get a calls from people, and I wanted to take this opportunity because you are here now. My parent purchased the property 20 years ago. Now my dad retired. How I can save taxes if I wanted to sell it because it is under his personal name? In terms of, because that's not a principal home, that's an investment. My dad purchased 15, 20 years ago for $400,000. And these are real facts. Like I get
Yeah,
these
yeah.
calls and people, and I don't have actually a real answer for them to say that, okay, this is how you could do something in there. Is there something where
That's
we
a
could-
tough one because reality is that it's just a rental
Yes,
property,
it's
right?
a rental.
So
It's not a
a rental
principal home.
property. It's not. So there's not much you can do to save
Yes.
taxes on it.
On
so
it. You have
sadly,
to, yeah, you have to sell it. And
Yeah.
okay, that's what I find. Figure it out also. Telling them, okay, the best is you have to sell it.
Yeah.
You sell it now, or you sell it 5 years down the road.
It's gonna
It's
be-
gonna be the same.
yeah.
You will be paying more actually taxes the more you wait on it.
and you're
It's going
supposed to,
be-
say the son wants that property. You the transfer has to happen at market value, right?
Okay.
Yeah.
And if I sell it, what's the tax will be? I purchase it for $500,000. Now the property value is $2 million. 1.5 million is my gain. So
And under the old rules,
yes,
750,000 would be
Taxable.
taxable, and at the 25% rate,
right.
right?
Will
Or
that-
50% rate.
50,
so
yeah, because
50%,
it's a
right?
because it's
So-
a personal name.
Yeah, exactly, right?
Shit,
so
that's a
50%,
lot of tax.
50% rate, right? But now, under the new, the first 250 would be taxed at the old rate,
and the
then
remaining
the
will-
remaining would be taxed.
But
at-
even with the old rate, that's a lot of tax I'm paying it,
is,
on
it is.
750. I'm paying almost 375 because it's on my personal name,
Yeah.
which is 50% of it is
Yeah,
going to be.
yeah.
Yes. So, that's a lot.
It is a
375
lot of tax,
money.
yeah.
So
yeah.
he's paying 375, and then he's paying to the realtors about $50,000. So give or take about $500,000 is his expense if he's
Exactly.
making 1.5 million profit.
Yeah. But see, that's the thing. Okay, so that is happening, and it's in his control a
Yeah.
little bit, right? Where he can sell to his son or to figure out how he's going to do this, right? When the issue is when there's a death, and honestly, people are dropping around us. Like
Yes.
there's
Oh,
people
yeah.
like, in their 70s, the next
Yes.
generation, right? So if say something was to happen to
Yeah.
the person, all of a sudden the tax that gets triggered is massive, right? So it's not just that rental property. Say he has an investment portfolio.
Yeah.
That 250 is
It's
just one time.
One time, yeah. And
right?
it's gone. Like
it's
it will
gone,
go,
right?
it
So
will
it's
go
one
very
time in
quickly.
that year,
Yes.
right? So if he's
He passed
got a
away,
bunch of
yeah,
assets,
assets in there.
he should time it where he's selling one every year to get that 250
50 every year.
every year.
Okay. So
Yeah.
that 250 exemption is every year. It's
Every
not,
year.
and every property. And
Yeah.
every property also. Not, sorry, every property, but 1 year calendar
1
years.
year, yeah.
So if I have 5 properties, I'll start liquidating it one property at a time.
Yeah.
Because if I pass away, then it's a problem because everything is on the same day.
Exactly.
And you have to be, it's huge taxes on it.
Exactly. Yeah.
So if that happens, what's the way out is? What's the parents, because maybe there are a lot of elder people are watching this too, and what they should do? They should do a financial planning, insurances. What should they do?
So
it?
there's techniques that you can take, like especially with a corporation,
Mm-hmm.
right? So you can the way the corporations get taxed, it's almost worse,
Yeah.
right? Because all of a sudden, your corporation, whatever you've built in there, is the value of that corporation is. That's what you're gonna be. That's your gain right there,
Yes.
basically. Because most of the companies start with, $100,
Yeah.
right? So that's how the
Yes. Oh, you're talking about the
cost-based-
business, because the business, when they're going to be selling the business to, or they shut down the
when,
business completely.
when the shareholder dies.
Yes.
So
Okay.
shareholder dies.
Yeah. The operating company, the business of it is.
Yeah, it's
gonna
whatever the
pass on to
value
this
is.
kid.
It doesn't pass
Okay.
on to the kids. It doesn't pass on.
Why
to the
didn't know
kid.
that about? I
No.
thought, okay, if the business automatically can go on it, pass on to my son. No, okay, I have a construction company now.
Yeah.
It's doing good. I built it up for 20 years,
Yeah.
and I passed away. So,
yeah, so-
my
so-
son is not automatically going
And
to be a
say-
CEO of the company or the shareholder of that company.
No. There's
Or-
huge tax on that.
Or if I write a will that after I pass away, my son will be
No.
the shareholder.
No. So the CRA, the way they say every asset you own, right, which is investment in this company,
Yes.
right, this company you own, every asset you own is deemed disposed at market value. The day
Yes.
of
So
death, basically.
what would be the way out solution for
so you
that?
gotta
is-
this is where that succession planning needs to take place.
Hmm.
So we are getting we were talking earlier,
Yes.
right? So we're getting a lot of clients that are now the next generation, right?
Yeah.
Which is, in their 30s, 40s, they're coming up and they're saying, my parents built this company,
Yeah.
and they built this group of companies, and there's no tax planning, there's nothing,
Nothing
in
in there.
case something happens to them. What do we do?
Yeah.
Right? And if something happens to one spouse, it goes to the next.
Yes.
Right? But when there's one person left, then there's issues. Right? Then then the
And
succession planning is urgent.
a person should start it, like someone like me
Yeah.
who's in his 40s, my son is only 8 years old. Is it too early for me to start planning it for my financial planning? The company is only
no,
like 4
you
years,
should.
2
There's
years old.
no, so there's steps you should be
Taking it right
taking.
now.
You know, purchasing
Yes.
corporately held life insurance and all of the other
Yeah.
measures like that, right? There's steps you should be taking, and eventually, I mean, you could set up a family trust, right, where you've got beneficiaries listed as
Right.
and your whole family's listed as a. And, you know, there used to be a lot more benefits to a family trust.
Yes.
Like you could split income and everything else. But now those benefits are gone, but there is a huge asset protection side of things, right? And asset protection, a little bit of succession planning, and how do
Yeah.
we get the next generation to come get involved in the business.
Because
Yeah.
this is very important. People don't pay attention towards it, and
It's-
this is
Honestly, if we could,
Yes.
that is something that, especially and the impact of this, the inclusion rate on those people is the most,
yes.
right?
Yeah, people who are listening to it. Talk to your accountants, financial planners, or if you don't know who to go, you have a person right here, Mandeep. You can go to her. She knows what she's doing, so she knows it. So she's
Yeah.
very good on it. So Mandeep, now coming back again, I'm tightening up everything with the real estate because majority of the people here
Yeah.
become millionaires with the real estate only.
Yeah.
So, to begin with, as a smart investor, should they start it with the incorporated company? I am not having any more properties. This is my first property. I'm buying it, or should I just go under a personal name that will benefit me?
So again, it comes down to if you're a business owner, right? Go keep it at the corporate level because
Okay.
you're not gonna. It just doesn't make sense. How are you gonna put the money out to invest into it? Right?
But when I'm buying it under a holding company, can I write it off the expenses on the rental income I'm having it?
yeah,
I
So,
can.
yeah.
Versus personal, I don't, or can I do it in the personal?
It's the same deductions that you would normally get. Like, so all your property taxes, all the mortgage interest, everything
Yeah.
gets written off, right? So the same way, the write-offs happen the same way. The only issue is that to the initial investment, right? If you have personal cash sitting and you expect the gain to be about, say $500,000,
Yes.
right, in a few years, right? Then you can invest that personally and it's fine, right? You've got the personal cash to invest. You put your name on it. You put your wife's name on it,
Right.
right? So you've got the 500,000 at the lower tax rate,
Yeah.
inclusion rate, right? So that's how I would do it if you have the personal funds,
Personal funds.
right?
Okay.
And you don't expect the gain to be ridiculous or,
Yeah. So,
Yeah.
one aspect of the investment is the capital gains. One, the income you're generating from that property, which is rental income. How I can smartly save taxes on it in terms of not, because rental income is 100% taxable, correct? Is it?
Well, it is. It's all
Yes. It's
taxable,
all
and based on
taxable.
your brackets personally,
Yes.
right? You
So,
would just add that to your income.
Unlike capital, there's only 50% of the income is taxable. If I'm simplifying it, if I'm getting $3,000 rent, so that $3,000 is taxable. Is that
Exactly. If it's that your net rent after all your expenses.
And what
right?
are the expenses? Are they counting mortgage? My mortgage payment is $2,500, principal plus interest. Only the interest will be the expense,
Exactly,
right? Not the
exactly.
principal.
No, not the principal.
Okay.
Yeah.
So let's say $500 is tax. Oh, sorry, the interest. So only that will be taken out of from the income.
Exactly. Yeah.
Okay. So out of $3,000, if my $500 I'm paying it as an interest,
Yeah.
so only that will be done, and $2,500 will be actually going to be taxable.
Exactly.
And that is 100% taxable on my personal side income.
And then it just gets added to your income, and then say your tax bracket is 53%, then you're paying taxes at that rate.
But if it is under an incorporation,
yeah.
then that $2,500 will be counted as an business income, which is 11 to 13% tax.
No. So it's
Okay.
not business income. Rental used, so say you have rental properties, whether they're commercial, residential, whatever
Yes.
it may be, they're taxed differently. They're considered passive income in a corporation, right?
Okay.
So they're taxed at a higher rate. So you are closer to your taxes, you're paying tax on the 100%,
Yes.
right? At about 50%, almost 50% rate.
Okay, so
Right.
that is not going to be going under the incorporation side, the business side. Okay, 13.
Yeah. No. So you
Okay.
pay heavy tax on it, right? But there are some benefits when you pull the money out. So
Yeah.
say you take dividends out of that company because you've got extra cash there now and you want to pay yourself dividends. You get this refundable tax in the company. right? So your corporate tax balance goes down
Okay.
based on the dividends issued.
So I own a commercial plaza.
Yeah. Mm-hmm.
The rental income is coming there $20,000. My monthly mortgage payments are $15,000. $5,000 is a positive cash flow. So times 12 is 60,000 now.
Mm-hmm.
So that 60,000 is taxable.
At a
100%
higher rate.
At a higher rate, and that is on the basis of the so it will be that 60 is 13% if it is under holding company.
No, it'll be at the higher 48.
48.
Yeah.
So no matter whether you and why is it so?
So it's because it's passive, right? So it's not you're not actively involved. So
they are counting it not as a business income because
Exactly.
it's not it's a passive income.
yeah.
They're counting it.
So it is taxed at a higher rate, but then as soon as you issue a dividend, so that 60,000 that's
Yep.
left in the company, say you pull that out, your tax rate in the company will go down,
Okay.
right?
Yes.
So it's in simple terms like that.
Yeah.
That's all it is. So you're paying high tax first.
Yes.
If you leave it in there, then you're going to continue paying high tax.
High tax.
Right?
If I pull it out,
You pull it out. Say you leave it in there year one, you pay high tax. Next year, you decide to pull it all out. All of a sudden, your tax bill goes down quite
go
a
down.
bit.
Okay.
Yeah.
So
Corporate
it's
tax
a
bill.
good strategy to pull out the money rather than letting that sit there.
Exactly. Always.
Yes. Always
Yeah.
you take it out, and then because of your income on the business side will be coming down.
Exactly.
Right. So you pay less taxes on it. Okay. That part I didn't know.
So yeah, so the holding company, you want to try taking dividends out of a holding company
Yes.
rather than the active.
Active,
Yeah.
operating company. Going
Exactly,
To be.
yeah.
The small nitty-gritty things on there. So it's just such
There's-
important thing
I
in
know.
there.
So
right?
it's like you almost have to sit down and be like, okay, come up with a plan. And so honestly, we see the opposite. We see people just, like I said, randomly incorporating,
Yeah.
setting up businesses, pulling money out of wherever they want to, right? So it's, yeah. And about rental properties, the only way it becomes active business is if you have more than 5 employees in that company.
And you can have those employees as your family members too, can be?
It has to be reasonable,
Okay.
right? So you can't have one commercial unit,
Yeah.
one commercial building even,
Building.
right? And say that you've got more than 5 people working there.
Yeah, what are they doing there, right?
No.
It
Yeah.
has
So
to,
to make it active business, it has to be more than 5 employees.
so is it fair to say that, okay, we are working in Canada just for CRA?
Our taxes are, I mean, yeah, people complain a lot about taxes. And it is, I mean, we do have some benefits, but
Yes.
at the same time, it's a
CRA.
it's
So
a-
at one point in time, you start feeling like, especially when you start making 6 figures, okay, what is this worth for? Because everything is going tax to the government
Yeah.
now. I should not work this hard
Yeah.
to make it.
You just gotta do it a little bit smarter.
Yeah.
I feel like organize yourself in a way where okay, how do we do this? What is an optimal amount of money I should be pulling out of the corporation, right? So
Yeah.
it has to be very planned out and well designed, right,
Yes.
for you to take, create that tax efficiency,
Right.
right?
Yeah.
Rather than just
Going all,
oops.
going without the plan, the strategy.
Exactly, yeah.
No, that's very important. And I've said many times to my clients too that your real estate investment, real estate as a product is one thing, but there's so many other strings which are attached to it. And make sure you have those people in your team, your accounting, your lawyer, your realtor,
Yeah.
your mortgage. Everybody has to
Yeah.
be there.
They
And
all have to work together,
Work
right?
together.
Yeah,
And don't
yeah.
keep changing it.
Yeah, and
Yes.
honestly, I think sometimes the issue is people think, okay, if they, they don't want to pay high fees, right?
Oh, yes.
So yeah,
Yes, the accounting side, yes.
right. So accounting side or tax side, they don't want to pay high fees, but then they're in a situation later where now they're paying so much more to CRA,
Exactly.
right? So
Yeah.
it's
you
pick
get
your,
what you pay for.
Yeah, pick your poison.
If you pay somebody cheap, and not saying that those people are not good in it, but they may not pay that same amount of time in it, or may not have the same amount of knowledge. Otherwise, why they're discounting themselves and trying not to be,
Exactly right, and then sometimes it's a little bit of like a lot of people accountants are busy.
Yes.
They're really busy, and sometimes if they are busy and they're not,
On top of it, so the things can go sideways, and it
Exactly.
can cost you thousands and thousands of dollars. Because
Yeah.
on average, maybe you will be saving annually. Your accountants' fees are annually.
yeah.
So maybe a few $100s here and there will be the difference only. And I know some people will say, "Oh, nahi Paji, he charged only $1,500 annually
Yeah.
versus $2,500." I said, brother, it's only 1,000 annually.
Yeah, the best
But
is
the benefit you're gonna get out
yeah,
of it.
the best is when they think they're saving taxes, right? Because one nahi karte.
Huh.
Yeah,
Another thing is very common in our community. I don't know overall is it or not. I see it out. People judge accountants to be good who are saving them taxes. That's it. They only think of, okay, they don't care about how the financials of their company is looking, because when
Yeah.
they go on the financing side,
Yeah.
even though they're making so much revenue generating in there,
Yeah.
because they didn't pay the taxes or they didn't strategize it properly.
Yeah.
Have you come across those
Oh,
people
yeah.
like they only just pick the accountant on the basis of, okay, this accountant said you don't need to pay the taxes, whereas versus example is Mandeep is saying you have to pay $20,000 as a tax annually. Let's go to the one who's saying not to. But they don't even understand, like, it's not that he's making something, he's just putting everything in expenses.
Yeah. No, we've had clients leave and come back,
Yeah.
right? So it's like, oh, no, this tax bill is like, this is the proper way of doing it.
Yes.
And honestly, like sometimes we do have those discussions with our clients too. What are your plans for this year? Are you planning on buying a house? Are you planning on,
Yeah.
so we have to declare dividends or create income that way, like, whether you're taking salaries, dividends, whatever you're taking out of the company, it's a discussion about what they plan on doing in the future, right?
Exactly. It's very important.
Yeah.
If you recall that one of our common client, can't take the name obviously, but he called me, said that he was buying a property, industrial property, if you can recall that conversation about 6 months
Yeah.
ago. He said, Jas, I'm changing the accountant from Mandeep to someone else. I said, why? Oh, my other old accountant said you don't need to pay taxes, whereas Mandeep is saying you have to pay taxes. I said, brother, but before you do this change,
Yeah.
can you just go more deep in it? Talk
Yeah.
to the mortgage person too.
Yeah.
Find out, okay, those draft financials which your new accountant is telling you no taxes, can you qualify?
Yeah.
He did it, and the lender said no.
Yeah, no, it's honestly like you have to plan
Exactly.
it.
You have to plan it. Then I have to put a thought in his head. Okay, if you're paying, it was about $100,000 tax. I said, if you're paying $100,000, you're getting a $10 million loan. Versus if you don't pay this, you still
Yeah.
have to pay 20,000. So
Yeah.
80,000 you're saving it as a taxes. I understand, but then you have to come up with a like 5 million down payment, which you don't have
Exactly.
it.
So people I think don't realize in order for them to grow, they
Yes.
have to. That's the only way to grow. You have to have strong financials,
Yeah.
and then the banks will invest in you
Yeah.
to go invest further, right?
Exactly.
So it's
I've said it in one of my seminars also that don't go to the accountants who's saying, okay, I will save your taxes, and just on that basis only you
Yeah.
wanted the good accountant to
yeah.
be considered
And honestly,
pay
it's like
taxes.
taxes. I'll save your taxes today,
Yeah.
right? Versus an actual plan for the future.
Yeah.
Right? So that's the difference. Like people
Yeah.
want quick, save my taxes today.
Yes.
Right? But it's not
Yes.
really
No.
about that. It's a think bigger
Yes.
picture.
Yeah.
Right?
No, 100%. I agree with this part is less. Yes, my not emphasize is one of the strategies I wanted to save taxes, but not on the basis of I don't get a mortgage anywhere. Like
Yeah.
how we
Yeah.
discuss about the financials also. 'Cause my financials, I don't want it to show my financials as a negative or less revenue generating
Yeah.
profits because
Yeah.
banks don't like it.
No.
And how are you going to grow your portfolio in real estate then? You can't. This is which is unfortunate. People don't understand. They
Yeah.
feel like, okay, no,
It's-
this accountant saying taxes are too much.
It's short-sighted, being
Yes,
short-sighted, right?
yeah.
So you have to think bigger plan. Yeah.
So, guys, if you're listening to this and watching it, see, it's not a realtor only saying it. Even the accounting is saying it
Yeah.
also. Pay some taxes to the government. Look at the bigger picture because end of the day, that tax which you're paying it to CRA, bank will support your financials, your company is going to grow.
For sure.
Yeah, you will get
Yeah.
more benefit out of it. Don't have that mindset only. Let's save.
Yeah.
Because then you won't grow.
No.
Yeah,
no,
you won't grow. And
exactly.
the people are sitting thinking of how this guy purchased on a 100% financing basis. Like, and why can't I?
Yeah.
Because I said you don't pay taxes.
Yeah. You need someone to actually sit down and come up
Yeah.
with a plan for you, right? That's
Yes.
all it is, right?
Yes, and see how much you're putting it. For example, that gentleman we were discussing about the industrial land, he paid $100,000 or something, $80 to $70,000 extra. But look at the leverage he got, $10 million property,
Yeah.
95% financing.
Yeah, and I think you
Yes.
helped him flip it
Yeah.
right after. So it's like I
Yes.
think he was
It
very
good,
happy.
Good, yes.
Yeah,
It was.
yeah.
It's a teamwork, right?
Yeah,
It's
yeah.
a teamwork.
Teamwork.
Good accounting side, good lender side, and then I can
Yeah,
chip in
yeah,
and say
yeah,
that little
yeah.
bit of my expertise
Yeah.
on real estate, and then we can do it together.
Yeah.
No,
Yeah.
that's really good. Mandeep, before we finish up, anything else you wanted to touch base on? Anything we have not discussed it, or you have something to share with the viewers? And
I think the only other a couple on the real individual side. So
Yes.
personal taxes, you've got the home buyers plan now that's increased from 35,000. Remember the RRSPs?
Yes.
If you're an individual, you used to put RRSPs to 35,000
Yeah.
each person to purchase
The first time, yes.
So that's increased to 60,000
So now you can take out basically up to $60,000. You can take it out if you're a first-time home buyer.
Out of your
and
RRSP.
Each. So
Yeah,
120
Yeah.
without any tax on it.
Yeah.
As long as that's your first property.
Exactly.
So there's
right.
no tax on it.
Yeah.
So that's a good thing too.
Yeah.
Versus it was 30,000.
35,000 before.
So
What I used to, I'm not a big believer of
Yes.
RRSPs, right? And I've said that. Right?
I'm the same.
Yeah. So, but if you are
Putting money into RRSPs.
or if you're purchasing a house, I think it always makes sense to do this, right? So if you have RRSP room and you're purchasing a first-time home, what I suggest is, even if you don't plan on repaying that back into RRSPs, I suggest you take the 60,000, put it into RRSPs, let it sit there for 90 days before completion, right? So there has to be 90 days.
90 days lock-in.
Right? And then you pull it out, and then you don't have to repay it back. It'll be slowly added to your income each year.
Exactly.
Right?
Yes. Yeah.
So
that's how I did it when I purchased my house too.
Exactly. It's a great benefit.
Benefit to it.
Right?
Yeah.
Because you get initial
tax benefit out of it, and then slowly you pay back.
Yeah.
It's not the whole amount, you have to pay it together on it also.
Exactly.
Also on the rental side, we were talking off the camera, was it the rental side, the CMHC new program, which the government has supporting it?
Yeah, so the government's providing 15 billion of additional funding towards anyone who is building residential rental apartments.
Okay.
Right.
Not for the selling. It's good. It has to be a rental building.
Long-term rental.
Long-term
right?
rental.
So say you have a project that you decide that on this property, I'm going to build long-term
rentals,
right? It has to be more than 5 units.
Yeah.
Right. And then you're minimum of like $1 million financing, but they're providing additional funding of 15 billion.
CMHC was already there. They were existing. So what's the new now additional is?
It's just the government's.
Okay, so the government is funding it.
Funding additional 15 billion. So it may get a little bit easier for some people to do this now.
Okay, so if I'm a developer or I have a piece of land where I was planning to sell a multifamily condo building, rather than selling it, if I rent it out, I can take a leverage on it on terms of mortgage side, because the bank, CMHC, will give me better mortgage rates and more money down to build it.
Exactly. And then there's actually, so the amortization period on those loans is quite...
40 to 50 years.
50 years,
50 years. CMHC, 50 years.
So there's that. And then, so it is a good way to kind of get that project going and holding it, right? And the other benefit that they introduced, so 2 other benefits, actually, GST. So usually what used to happen was anyone who built this buildings, as soon as they rented it out, they had to self-assess GST on it and pay GST.
Pay a GST on
so they said you don't have to. So as of last November, they changed the rules on that. And then in this proposed budget, I think you're pretty familiar with amortization on CCA and amortization, right?
Yes, yeah.
On buildings.
Yes.
It used to be 4%.
Right.
They're increasing that to 10%.
So
only for these rentals, residential rentals.
So basically, they're heavily telling guys build rentals because we needed it. And when you say long-term rentals, means like how long I have to hold that property for the rentals? Like let's say I built a condo story, which is 40 condos. I rent it out because I wanted the better mortgage side leverage on it. For how long I have to?
I'm not too sure of that, but I know that the long-term rental, the way they define that is, it has to be rent. It can't be Airbnb or anything like that. That's their definition of long-term rental. So it has to be more than 30 days.
No, when I say sorry, not that side. I'm talking about like I have to hold that building for not selling it individual units later on, or can I do it? Is there a lock-in period for that?
I think you say you held it for a couple of years, right? But the only issue is when you sell it, now your loan, you don't have the same advantages, right?
Okay.
So you've sold it, and then if you sell it, you've got capital gains at the.
That side is going to be the flip side of it is going to be always a capital gains.
Because that's not business income.
Yeah,
right?
that's not a business income. That's true. Yeah. No, thank you, Mandeep. Thanks for coming by, and it's a pleasure talking to you. And again, guys, if anybody wants to talk directly to Mandeep, we will share the information of her company too. She, not that I have a biased opinion, because she is my accountant too, and she's awesome. I have sent so many of my clients and none of them have come back to me, Mandeep, saying it, no, you send us to a wrong place. And not that because, again, you're sitting here saying it, you're very good at what you're doing it.
Thank
And
you.
you've been my accountant from last, I think, 4, 5, 7 years, maybe. First couple of years, as a realtor, I was having different. Since then, she's amazing. And I was all over the place with my portfolio. Still, I'm trying to managing it, some things, but she's good at it. So you should go to her and at least talk to her. Thank you, Mandeep.
Well, thank
Thanks
you for
coming.
having me.
No,
Thank you.
thanks a lot.
Yeah.
Thank you.